There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, and welcome to the COB. It is the 8th of September. It's a pleasure to be here with you. I'm Nadine Blaney on a day, unfortunately, that we are seeing a bit of negativity out there. So the COB Australia index on your screen right now down by 0.3%. The curtain has come down on that market. I'm still keeping an eye on the S&P ASX 200. I don't think there's going to be any major improvement. It's off by 0.25% at 8,846. But of course, we still do have some of the day's trades rolling through. So we'll keep our eye on that. E-minis in the US have been higher all day, although the S&P 500 E-minis are just marginally in positive territory. And around the region, we've had positivity. The Hang Seng is up by about 0.4% just past 4 p.m. here in Sydney. And also Japan's market pushing about 1% higher. Now, we did have data coming from China. It was a miss, so exports slowing to a level not seen for the past 6 months, actually. However, I just had a really interesting talk with Clyde Russell from Thomson Reuters. We'll get it up online shortly. And he said that if you look at the detail in the data, we're seeing a pretty encouraging shift from Chinese exports to the US, which were down by about 33%, to other Southeast Asian countries and the like. So China's moving somewhat successfully, at least early indications are, away from the US market to other markets. So China missed, but gold did hit. So we continue to talk about the price of gold rising. Had a number of good conversations today about that one. Clyde Russell being one. Also spoke with Van Eck about how you can gain exposure to the gold thematic when the miners look to catch up with the price rises. So that as well can be found online. But as I had said, we do see the market down by about 0.25%. So underperforming our regional peers, including New Zealand's market, which closed 0.4% higher. All right, taking a look at some of these sectors, look no further than the banks for weighing on this market overall. You can see the exception to the rule is CBA. Interesting because it was also lower earlier in the session. Some of the insurers doing particularly poorly. We are talking now about an even 50 basis point cut coming from the Fed, which could impact the insurers and the balances that they hold in investments. When I look at sectors overall, though, further to the banks, we're watching energy come under a lot of pressure. OPEC Plus looking to increase production. 7 out of the 11 sectors locally are lower. Tech is the best performing sector. It's up by about 1.4% overall. WiseTech Global. We did have a broker weighing in on WiseTech Global positively, I should say, and that's part of the reason why we're seeing that lift coming through there. All right, a few corporate stories out there today. Woolworths and Coles says that underpayment costs could hit to the tune of $1 billion. Platinum Asset Management did see its share price earlier falling on lower funds under management, but has since recovered. Drone Shield up by 6.5%. It will be joining the ASX 200 on the 22nd. DeLorean has inked a gas sales agreement with Origin, and that has really sent its share price higher. Gorilla Gold Mines found gold in WA at its site there, so it hit a 3-week high earlier on. Quick Fee, check it out. sold its U.S. payments business, up by close to 76%, still a 10-cent share though. Elsight, its share price has lifted on a European contract expansion, while Prophecy has slipped on a soft FY26 outlook, down by close to 11% to 31 cents per share. And 4D Medical has hit a near 4.5-year high on fresh agreements being inked. The share price is up by 51%. I caught up with Nathan Somasundaram from Deep Data Analytics and David Novak from Wealthwise Education for their view on 4D Medical.
It is a high-risk investment, but I do like what they do. I mean, it's got all the bingo words for me. It gets me every time. I think you should always have a small amount of money invested in a few fast horses that can be massive returners. And you have to assume that if you have 10 of those small players, probably 8 or 9 not going to do much. Probably half of them will disappear, but you'll make money on 1 or 2 if it's a law of averages. So I would say if you pick well, then you've got to get 1 or 2 winners.
Created a base there at 20 cents and then whammo, this is what we're talking about. But I really like the product, and I was disappointed that it went back down. I was really disappointed. So yeah, I just didn't get back into this one. Would I be buying it right now after, this is a 10 bagger, it's gone up tenfold. Geez, it's hard to, jump in. I mean, big volume, there's massive buying volume here. I'd wait for the dust to settle.
Positivity. So specky buy coming, or no, just a buy coming through from Nathan. And look, David just couldn't stomach it today, but it's on his wish list. He really believes in the company overall. So you can find that extended analysis online at ausbiz.com.au. Let's welcome in my guest today. Clifford Bennett is joining us. Clifford, pleasure to have you with us. Nice to see you. So this is a big week, isn't it? We have some crucial data coming out in the United States, particularly in the wake of that jobs read on Friday. What are you expecting from the inflation data?
Well, I think that jobs read on Friday, just very quickly, it was sort of a COVID number. So the US economy is in trouble. Some people are surprised, but as you know, I was way too early in being bearish on the US economy, and I still am. Manufacturing depression and so on. And I see the tariffs as being an isolationist policy move, which could inflict the US economy long term. So all that aside, then we move to the inflation data. But certainly that labour data has the Federal Reserve looking to cut rates. I'm not sure they're going to cut 50 though. I think probably 25, and that's still on the agenda, unless we see a very serious spike in the inflation number. And I think the best way to look at US inflation at the moment is that the tariffs are going to be increasingly passed on from the corporate world, from the profit sacrifice to the consumer. So US inflation will be increasing, but it's more like a slow tide coming in across a long beach than a tsunami. But the tide is coming in on inflation in the United States. The Federal Reserve is very much aware of that and has expectations of that, but it also sees as a crisis developing for the labour market and a definite softening in the US economy overall, despite some aggregate numbers looking a little bit better than perhaps is the experience of most of the economy. So I think the Federal Reserve will be mindful of 2 things on these inflation numbers. Will they allow for them to cut now, or do they need to aggressively cut? And that's when the market could get their 50-point rate cut. They could be spooked by a higher inflation number into actually cutting by 50 points, seeing it as their last gasp opportunity to do so.
Yeah, okay, that's an interesting way. Go ahead, Clifford.
Yeah, I have a feeling, though, that we might have seen the only Fed rate cut for the rest of this year already. I do think there is upside risk to the inflation data, and we have seen the core inflation number really take off in a significant way. And that behind closed doors would be of great concern to the Fed. It does see the tariffs as creating disarray and confusion in the economy among business leaders and decision-making and consumers alike. So that too, without worrying about what the labour data is doing, is a reason for the Federal Reserve to cut. So we could see a Fed cut by 25 points. I've sort of bounced around a little bit with a lot of different angles on this, but I guess my core view would be that the Fed could cut by 25, but I don't think they will. And I think 50 is a long shot bet at best. So inflation, I think this week, if anything, will startle to the upside, but even sideways maintenance of the current inflation numbers or the slightest uptick will reinforce in the Fed's mind, if not publicly, behind closed doors, that there is this slow rising tide of inflation where there is no end in sight in terms of that tariff impact.
So just to clarify, so you're saying that there will be no move coming from the Fed this month?
That would be my core view.
Okay, so
yes.
What happens to markets? I mean, that's a big question, but what happens to, say, equity markets if that is in fact the case?
Well, I think the relationship between interest rates and the equity market is greatly overdone. If you do any correct historical analysis, you'll see that interest rates and the equity market usually move up together, and interest rates and the equity market usually move down together. This goes against the cultish religious belief to the alternative, but it is what history shows us. And it makes perfect sense because the old inflationary pressures came only from really, there was the oil shock in the early 70s, but really only came from overheating economies. So if you have an overheating economy, there's going to be a lot of profits, the share prices are going up, and at the same time you have a lot of inflation, and the monetary policy response is to raise interest rates. So that's how they would often rise together. They would often fall together, as we've seen numerous times in our own careers, fall together on a fast slowing economy or an economic shock that causes stimulus to be required for the economy, and so stocks and interest rates fall together. So the fact that the Fed will not be necessarily lowering rates may have negligible impact actually on the equity market beyond a knee-jerk response on the day. And I still see the number one major driving force of the US equity market as being this historical aberration in terms of the level of government money printing and spending and budget spending that is flowing through to the equity market with delay. But it's so immense and so aberrant on a historical basis that we really can't limit in terms of our forecast the impact that this excess liquidity will continue to have on the equity market until it all comes to an end, of course. But that end could be at Dow Jones 50,000. The recent price action has been a little bit hesitant around these inflation numbers. Certainly if these inflation numbers kick up a lot, despite all the reasonably objective things I think I just said, despite that, the market will want to believe that lower interest rates will be good for stocks. So that the market, the majority of participants will be watching the inflation data to see if it's going to allow the Federal Reserve to continue to cut rates, knowing the Federal Reserve wants to cut rates. But I think it will be 0 to 25, and the market impact of a high inflation number, which could spook the market the way the market sees things. A bit complex, isn't it? But that would be a knee-jerk response and probably more likely a buying opportunity than not.
Yeah. Okay. So what markets are you long now, Clifford?
Still long Apple, still short Nvidia, short Microsoft actually, but I love being long gold. And I'm not too confident on the Australian equity market just in the near term. But certainly if the US market were to take off after these inflation numbers, the Australian market could also take off like a rocket. I mean, the US market's a little bit hesitant here, but it could really take off in a big way, and you could almost own anything. I noticed the strength in the Russell 2000 as well. So this has been a broad-based rally that we haven't seen before over the last few weeks. So it is reassuring for the US stock market. In terms of my favorites, though, I've got to say gold. I'm a bottom picker in oil and getting it wrong at the moment. The US dollar, I do like buying the euro against the US dollar, not so much the Australian dollar. I do like buying yen against the US dollar because of even with the Prime Minister resigning over the weekend, the yen has maintained some reasonable level of strength, which suggests that once we get through that news, it could be even stronger. So I guess I'm a US dollar bear. I'm wrong on US bonds. I have been bearish for the moment. I'm an oil bull. I'm wrong. I'm a US equity bull on excess liquidity only, no other fundamentals. And I'm cautious on the Australian market. That's the Clifford Bennett wrap.
Yeah, all right, but I am going to push you a bit, Clifford. Why relatively negative on the Aussie market?
Because I think, which was exhibited by the CBA price action going way beyond what would be normal fundamental multiples in the Australian market, was the standout example of something that was happening across all of the market, but heavily focused in a stock like CBA, and that is US hedge fund buying of the Australian equity market. A general shift has taken place in the mindset of that sort of, 3 block by 3 block area that has something like 3,000 hedge funds in New York, and also the New Jersey set, where they decided that actually Australia is a bigger flavour of the month than we had previously thought. And they've been going out of their way, and it's supported the currency as well, in buying Australia. And we've seen that across every industry, be it equity buyouts or stock market buys in large volumes. And CBA really did rally on that. And when I called the CBA top, it was because they sensed that New York hedge fund sentiment had sort of got to a point where it was time to take profits, and that's what we've been seeing in CBA. I noted your point earlier that CBA was a little bit stronger, so maybe the sell down, the profit-taking phase by those US hedge funds is complete, and maybe we'll see some stability, if not upside, for CBA from here. But it could be out of kilter with some of the other bank stocks because of this heavy focus of US hedge funds. The reason I'm cautious on the Australian market now is that I think really a lot of that investment flow is probably topping out a little bit here for Australia, with the recent hesitation in the price action causing those big fund managers like BlackRock, Vanguard, First State to go, well, perhaps we've done enough buying for now and we should just be a little bit more cautious. But everyone was racing to get a foothold earlier in the year. Now I think they're going to be a little bit more cautious and prudent about their buying. They will still be buying, but in the short term, I think there's going to be a little bit of hesitancy from that specific clique, if you like, over in Manhattan.
Well, Clifford, always good to catch up with you and your views. Really appreciate
Thank
it
you for
today.
having me.
Take care.
I really appreciate it.
We'll see you soon. All right. So that'll be interesting if we do not get a cut. When the market is sort of half positioning for that 50 basis point cut. We'll put that up online if you'd like to take another listen, or you can re-listen to that if you're enjoying the podcast. Let's get you across some of the market leaders and laggards. Life 360 today on No News. Boss Energy up by 5.3%. We've got some positivity amongst the lithium names, as well as Mesoblast up by 4.25% to $2.21. Now let's look at what underperformed today, and a lot of this has to do with the companies trading ex-dividend. I had a great conversation with Andrew Dale from ECP Asset Management today about IDP Education and its report. You can find that online at ausbiz.com.au. I think its title is Andrew's Reporting Season Playbook or something like that. We talk about GYG and gold as well. In the small to mid-cap space, Tulu Minerals up by 22%, Satire up by close to 18%, and those that underperformed, we are watching Main Pharma off by 15%, Biome down by close to 11%, and Ardria Resources off by 6% to 46 cents per share. Tonight, actually, I think it's happened already. We've got German industrial production figures. I think that was 4 p.m. local time. We get investor confidence in the EU, and we get Federal Reserve consumer credit data in the United States. That's for the month of July. Now here tomorrow we get the Westpac Consumer Confidence, so that's monthly, the NAB Monthly Business Survey. In the US, we get the NFIB Small Business Optimism Index, and we have a whole bunch of companies trading ex-dividend, some of the bigger ones, BlueScope, CSL, News Corp, and Regis Resources. So let's see, did anything change when it comes to the S&P ASX 200 and the final market finish? It looks as if ending down by about 0.25%. And where have you gone? Yep, 0.25%, 8,849. We still do have U.S. futures into positive territory. And yeah, we'll be keeping our eye on European markets as well. I was just having a little look for that German data, not seeing it here. Keep an eye on Japan. We've got leadership bids after that prime minister did resign. We also have France's 4th prime minister in 3 years facing what is being told as certain defeat in a confidence vote that's coming on Monday. So we've got that as well as geopolitics, Russia hitting Ukraine again, and we'll see how markets digest that China data as well overnight and what that tells us about the impact that tariffs are having. That is the COB for today. In fact, that's a wrap for us at AusBiz for today. You can catch up with anything you may have missed online. I hope you have a great evening. We'll see you tomorrow.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.